Welcome to TheoTrade and the weekend update. This is Don Kaufman. It is September 24th, 2016. So lately I have been talking quite substantially about how efficient the markets happen to be. We're going to do things a little bit differently here on this weekend update. I'm going to talk again about efficiency of the market for those of you, whether you trade stocks, whether you trade options, if you trade futures, even if you're just looking at markets. This is going to be a little bit intense kind of weekend update. Nevertheless, I'm going to explain to you how and why there is such efficiency right now in the marketplace. And again, I've had literally hundreds of emails about this topic lately. So let's go ahead and get started. Of course, the S&P futures ending up on the week 2157. Nevertheless, to give you this example, we're going to go right into it here on the spiders. So the reason I've selected the spiders to explain the efficiency of the marketplace is in respect to the spiders are kind of a more retail friendly product. It's a $216 product, pretty much right on the money right now. The SPX, the SPX is a little intimidating. It's a $2,000 product. So in this case, we use the spiders, extremely tight bid offer spreads in here. Now, when I'm talking about efficiency in the marketplace, what I've been pointing out lately happens to be what we term the expected move. The expected move, and this happens to be on thinkorswim, it's in the upper kind of right-hand corner of each individual expiration. And it says in this case for the next 6 days, and that happens to be the end of the quarter, but that also happens to be a Friday. So it's showing through next Friday. Again, this is forward looking, right? September 30th. Forward looking, showing next Friday out there. The expected move is supposed to be plus or minus $2 and approximately 80 cents. Now, first and foremost, as I get into this, and I'll point out that $2.80, and at the end of the week, I'll be like, wow, we moved to a T $2.80. And it's ridiculous. Like, again, whatever the expected move happens to be, we've been driven right to the edge of that particular level. Now, that happens to be, okay, again, as I say, the expected move. But how is the expected move, number one, derived? And what does it really mean before I get into why the markets are so incredibly efficient right now? Well, the expected move, how it's actually derived, it's averaging option pricing in a given expiration. So again, we take this 6-day option expiration cycle. All right, the way to think of it is, all right, here's the spiders. They're right smack on to what? 16. We're going to add the 216 puts to the 216 calls. Now, we'll stop right there for a second. This happens to be what we call the at-the-money straddle. Okay, and the at-the-money straddle is trading for $2.54. Now, if you look at the at-the-money straddle, you compare it to the expected move, they're fairly close. They're, a few pennies apart over there. So if you buy the at-the-money call and the at-the-money put, if you were to do this, all right, what it would look like on a risk graph is something like this. Here we are right now, roughly 216, okay? If you buy the 216 call, you'd be like, please move up. If you buy the 216, please move down, all right? So the bottom line is you want us to move anywhere. And if we move nowhere, you'll end up losing, okay, $2.54. But that $2.54, that's going to buy you that at-the-money straddle for the next, couple of days out there. Now, the reason I point that out is, yes, the expected move over here, it's based on the option price. But what it does, again, is it averages a multitude of options. It doesn't just use the at-the-money straddle. So why does this matter? Okay, so right now, what's going on in markets is this. Trading firms are absolutely flush with cash, right? Doesn't matter whether you're looking at a bank, a trading firm, a proprietary trading firm. Yes, there's proprietary trading firms. Which is, think of a couple of people gathered to be able to make money together. Then you get into, your banks and derivatives firms out there, but they're just flush with cash. The central bankers are basically giving it to them. I mean, you go over and you think about some of the bond offerings, okay, the bond offerings and negative bond rates out there. Again, think you guys get it. Trillions of dollars are seeking returns. Well, All of that cash right now is flowing heavily, all right, into the option markets. And it has for years, but there's been innovation in the option markets, and they keep adding multiple expiration cycles. So now we actually have, in the SPX, we even have a Monday, a Wednesday, and a Friday expiration. Here in the spiders, we have like a Wednesday and a Friday expiration. But take this trade, for example. Let's say that a trading firm, okay, wanted to go out and they wanted to make money for a given week. How might they do it? Well, that firm might go out, okay, and not necessarily buy the straddle. Okay, let's say the firm went out and they sold the straddle. Okay, and what might that look like on a risk graph? Well, I'm going to go over to the Analyze tab. I'm going to go to Risk Profile. I already set one up. Here's exactly what a trading firm might do. And again, I'm simplifying this to one individual trade to give big concepts to you. Let's say a firm goes out, okay, and they sell an at-the-money straddle. All right, they're selling the at-the-money straddle. So here it is, and they're going to sell 1,000 contracts. They're going to sell the 216s. They're going to collect $2.54. Now look at the daily theta on that animal. It's huge, right? Oh, $17,000. But the problem with this strategy, okay, is number one, it would take quite a bit of margin, but that doesn't matter. They got money, right? It's a trading firm. They got money to burn. This happens to be what we term a market neutral strategy. What is market neutral? It means, okay, in this particular example, I don't necessarily want us to move up, and I definitely don't want us to move down, because if we move big, we start getting hammered. So if there's like a crash in the market, you think this firm is going to get crushed, but they're not going to get crushed. Okay? What this firm will do is they're going to hedge the trade. What does hedge mean? It's a reduction of risk. They're going to reduce the risk with the dynamic of the marketplace. It's actually referred to often as dynamic hedging. Again, simplifying it here. So in this case, what is risk? Risk, okay, in this case, we'll call it as delta. Delta is their directional risk. What do they use to hedge risk? They can use shares of the spiders. They could go out there and they can buy or sell E-mini S&P 500 futures. Okay, they could use SPX options. So the name of the game is, though, hedge the risk, hedge the risk, hedge the risk, hedge the risk. All right? Now, what would happen if the market started to sell off? Well, I'm going to show you. Here is, all right, the market at 215. What would happen, and watch the P&L over here and the P&L in the day, what would happen if the market sold off to 210 on the spiders? Okay? All of a sudden, if we went down to 210, you can see my little price slice over there, they would lose, let's say, $360,000. Oh, but still my heart. They're not really going to lose that, because what they're going to do is, as the market goes down, they're going to offset their risk. By doing what? By selling futures contracts, by selling shares of the spiders, right? So think about that. As we move, they're going to buy, sell, buy, sell, buy, sell, and they're using algorithms to do this. So they're doing it literally in real time. Every fraction of a second, they're buying and selling and buying and selling and buying and selling and buying and selling. Now, what do you think the implications are to the marketplace? And then that's where, you kind of have to, all right, wait, this is a new concept to me. I'm not even sure what we're talking about over here. What we're talking about, again, is that they're going to hedge this, all right? And by the skin of their teeth, they want to be able to collect some of this data in a market neutral stance. But again, they're trying to make fractions of a penny, and they're trying to do it millions and millions of times a day. So they go out and they sell this straddle. And you're like, well, who do they sell it to? Well, guess what? There's another trading firm that's willing to buy the straddle, and I'll show that in a moment. But because they sell this straddle in such enormous size, okay, and there's this incredible efficiency in the marketplace that they're hedging in real time, very often it's moving, the market's literally moving right to the edge of the credit they're collecting, right? Now, I just talked about a moment ago, there's another firm that's out there buying the straddle. And this is all, again, these big trading firms, okay? And you have to recognize that as the market moves, again, they're hedging in real time. Do you know what hedging does? It drives the markets. It actually moves the entire marketplace. So if you think about hedging, as the market goes down, this trading firm, all right, and if I say as the market goes down, look, I can actually make the market go down. I'm clicking right now, right over here, and I'm actually driving the market down. And as the market's going down, they're actually selling shares of the spiders to offset any P&L over there. And if the market turns around and starts to rally back up, they're going to buy those shares back very, very rapidly. Okay, so they're hedging right to the dynamics of the market. So again, this firm that sold 1,000 straddles, they don't want the market to go anywhere. They don't want the market to go anywhere, and they're hedging as the market moves. All right. On the flip side of this, well, what's the flip side? If the flip side, there's another firm that's willing to buy 1,000 straddles, and you're like, what are they, crazy? They're going to lose $17,000 a day, Don. Why would they ever want to buy the straddle? I'll tell you exactly why they want to buy the straddle. They're going to buy the straddle because they're going to go out and they're going to hedge it in a number of different products as well. They can actually hedge all that theta risk off. Well, how can they possibly do that? They buy the straddle in something like the spiders. Okay, now this is where it's going to get complex. They buy straddle in the spiders, and they may use something like VIX options as their hedge. So although one product they're buying here in the VIX, they're actually selling options in the VIX, or they're selling volatility futures. Now, you have to think about this. You have one firm that doesn't want us to move, that $2.50. You have another firm, okay, that wants us to move the $2.50 and then some, because if you buy a straddle, you want us to move huge up or down. And what we're actually seeing right now is this incredible inefficiency on both sides of the marketplace, okay? That you have this, and by the way, I'm simplifying this here just in the spiders. But you have to recognize this is being done in the entire S&P 500 in real time. They're not just going out there and buying a straddle in the spiders or buying a straddle in the SPX. They're trading the components of the S&P 500. They're out there and trading Google and Apple, and they're buying and selling options in every one of those products simultaneously, and then they're offsetting the risk in the futures. So all of a sudden, what you end up getting, because there's so much capital and everybody's flush with cash right now, what you end up getting is the market literally moving to the expected move, because you have two different firms on both sides of the equation. Those firms are both quite happy. Why? Because they're making fractions of a penny, and they're doing it millions and millions of times a day. But the reality is right now, things have become so incredibly efficient that trading firms that just a few years ago, okay, could risk X and make decent money, now they have to risk X times 10 to make the same amount. Now, what's going on right now is things are becoming so incredibly efficient that it's squeezing even the biggest firms on the street. And that, all right, is why we're moving right to the edge of expectations. And if you're not looking at this, you're missing the big picture, right? Because people constantly ask me, well, should I sell premium? And I go, well, you can sell premium. You can do it. But if you sell that premium, don't expect a free lunch out there. Meaning, like, you're not just going to go out and sell options and be like, oh, I sold options and I made money. You have to sell options, and you're going to have to reduce your risk, okay? Or you're going to have to sell options and be right on direction. Again, what's going on in the broader markets, though, what I find most interesting about this and the efficiency is in the shortest duration possible. So with all this efficiency, what it's doing, I believe, is actually dampening down volatility. Because you have these firms, they're all attacking. And by the way, the vast majority of the firms do want to be premium sellers. So it looks like that volatility is actually being suppressed right now, meaning that, although volatility is accurate here, it's 11% or so, it looks like it's actually being squashed down, right? It's being suppressed. And where I see a huge opportunity is out here in the future. Why the future? Because all these trading firms and all this volatility arbitrage that's going on is all in this short duration stuff. If you look right now at volume and options, it's all in the first couple of expirations. It's a 4-day, it's a 6-day, it's 11-day. Nobody's even looking right now 55 days out. Like, here's one of the most liquid products in the entire marketplace. This is it. It's the spiders, one of the most liquid products. Look at the 55-day options. Are they trading? Sure. 2,000 and 5,000. Okay. Maybe 3,000 contracts. Ooh, look. 13,000 contracts here. Did you look and see what's trading in here? Look at that. 10,000, 16,000. This is a Wednesday expiration. Nobody even heard of a Wednesday expiration until a couple of weeks ago when they enlisted it. Right? Look at the Friday expiration. It's out of control, people. All the volume is here. Right? That unto itself, again, is dampening down volatility. So net, when you look at a marketplace, right now, I want to be long volatility. Now, I'm not like completely anti-selling premium. I want to make it just abundantly clear. My entire trading career has surrounded being a net seller of option premium. I've never stood in front of any group whatsoever. I've never talked about, well, I want to be a net buyer. I don't necessarily want to be a buyer of option premium, but I definitely want to be long volatility out there. In some way, shape, or form, I want to buy volatility because, again, what we're going to get is this incredible suppression of volatility that eventually is going to go the exact opposite way. That if you look at markets right now, and I say you look at markets, whether it's the spiders, okay, whether you're looking at like volatility products, and people talking about the VXX, forget about all those things. You look at volatility products, they're really, really low. You start looking at products like, like Google. And I pick on Google a little bit lately because you open up look at these options. October 7th, there's 13 days remaining. They're trading for a 13.8% volatility. That's Google. It's one of the largest tech companies in the world. You compare it to something like Walmart, and I can't help but to compare it to Walmart. I'm sorry. Okay? It's Walmart. Do you see earnings coming out in Walmart? No, I don't. I see earnings already passed in Walmart. Walmart has a higher implied volatility than Google. All right? You start looking down the list and you start seeing things like, all right, the XLE, the energy sector, all right, give that to you. It's energy. It's kind of volatile out there. You look at stuff like Facebook. Facebook has like a 19 vol. Since when did we ever compare Facebook's volatility to a retailer? Right? What's a retailer out there? Again, I go to Walmart or I go to something like Target. Okay, Target. Target's got the same volatility as Facebook. A technology company that just based on ad revenue and so forth, the volatilities are being suppressed in every way, shape, or form. Look at Microsoft. Its volatility is lower, okay, than all of these brick and mortar stores. Hey, I'm not saying that Microsoft is a heavy risk company, but think about it this way. If you look at Microsoft, right, as an individual company with a CEO, is there tremendous risk in there? Possibly. Something happens to the CEO, right? Compare that to, say the entire financial sector. Granted, the financial sector, it's been through a lot lately, okay? The financial sector, yes, it actually had a spin-off in here. But as you look at the volatilities, right, and this volatility is clean right now. You look at the volatilities, it's got a higher volatility, all right, in the entire financial sector. Or you can go into, again, all these different ETFs. There's higher volatilities in some of the ETF products than there is, per se, in something like Microsoft. And that's when you start to really have to step back from the market and go, scratching the head over here, what's going on? Again, suppression of volatility. It is a highly dangerous time to go out there and to want to sell options in the very short duration. Because I'm telling you right now, every other monkey on the street wants to do that. That's what people are doing. Oh, let me sell options for the next 6 days. It'll work until one day we don't move 90 cents. Till one day we move $6. Till you start seeing, all right, the unexpected. See, an expected move is nothing more than a probability. It's about a 68% chance, okay? It's one standard deviation. What happens if the unexpected occurs? And that's why right now, in any way, shape, or form, I want to be net long volatility. And that's, you really want to start thinking about that, especially given a fact of the week. What did we see this entire week? Well, this week we saw the S&Ps rally back up, where stones throw off all-time highs. Everybody wants to know, where are we going out here? Well, the fact that we're so close to all-time highs opens up the door to that. Nevertheless, all right, What out here holds? A whole lot of risks in the very short duration. A lot of risks out there. And you really want to think very carefully about how much risk that you're willing to take in the short duration. That is what this market in the next couple of weeks and next couple of months is going to be about. Curb your risk. Keep your allocation under control. The volatility is inordinately low right now, okay, for all of these pending risks. And again, that volatility is low simply because there are premium sellers galore right now. I never thought I would say that, but there's so many firms selling premium. I don't want to be on the same side of the trade as them. Now being contrarian to me means I don't want to sell premium. I want to buy that volatility. It doesn't mean, again, I want to necessarily buy options outright, but I definitely want to be net long volatility out there. And do not think that I, in any way, shape, or form that is an advertisement to go buy volatility products. If you buy stuff like the VXX and you're going to buy stuff in the VIX, you're going to get run over in those products. All right, the UVXY is one of the most horrific products for people to hold. Just look at it over the last 6 months. Think about this, because throughout the week here at TheoTrade, it's actually going to be the topic of conversation. What to do in a marketplace that for right now has incredibly low volatility. Yet, again, the opportunity is to be net long vol. Thanks everybody for joining us here at TheoTrade in the weekend update. Back all this week here in TheoTrade chat. Have a good weekend. Bye-bye.